The stock market, a complex universe filled with intricate numbers, towering dreams, boundless opportunities, and occasional despair. A place where fortunes rise and fall with remarkable swiftness. But how did such a dynamic system emerge? Why does it captivate us so deeply, and how has it evolved into today's indispensable economic powerhouse? Our historical exploration begins in the 17th century Amsterdam, at the heart of a flourishing trade empire. Here, in 1602, the Dutch East India Company became the first enterprise to issue public shares, pioneering modern stock trading. Investors flocked, captivated by the potential to earn profits without physically joining dangerous sea voyages. Detailed records emerged, documenting transactions meticulously, thus shaping the earliest version of stock exchanges. Amsterdam's innovative market became a blueprint, setting foundational principles for transparency, regulation, and shareholder rights that continue today. In America, the seeds of the stock market were planted in the late 18th century. Philadelphia established the nation's first formal exchange in 1790, creating a structured environment for trading government bonds and company shares. Shortly after, in 1792, New York brokers signed the historic Buttonwood Agreement under a buttonwood tree on Wall Street, laying the groundwork for the New York Stock Exchange. Early trades were conducted openly, face-to-face, relying heavily on trust and reputation. These exchanges rapidly became critical financial centers, facilitating economic expansion and industrial growth through coordinated capital mobilization. The stockbroker's role evolved dramatically from mere intermediaries into powerful financial influencers, particularly throughout the 20th century. Stockbrokers were renowned for persuasive and aggressive cold-calling techniques, pitching lucrative investment opportunities to potential investors. During the notorious boiler room era between the 1960s and 1980s, high-pressure tactics dominated, with brokers often manipulating unsuspecting clients into risky investments. This controversial period prompted regulatory scrutiny, resulting in significant reforms designed to protect investors and ensure ethical conduct. Modern brokers now operate with rigorous compliance frameworks, providing investment advice while adhering strictly to transparency and accountability standards. Valuing a stock accurately is both an art and science, demanding a comprehensive understanding of financial metrics and market dynamics. Fundamental analysis involves deep dives into companies' financial statements, assessing profitability, debt, cash flow, and market positioning. Technical analysis, conversely, relies on historical price charts and trading volumes to predict future price movements. Key valuation tools include price-to-earnings ratios, dividend discount models, and comparative valuation techniques, enabling investors to make informed decisions. Each method brings distinct insights, highlighting either underlying company strength or market-driven sentiment, thus guiding strategic investment choices. Initial public offerings represent pivotal moments in corporate history, transforming private enterprises into publicly traded entities. Investment banks such as Goldman Sachs and Morgan Stanley expertly orchestrate IPOs, meticulously guiding companies through complex regulatory landscapes. These banks conduct rigorous financial due diligence, evaluate appropriate share pricing, handle extensive regulatory filings, and manage investor roadshows to generate market interest. The IPO process culminates in the official market debut, a carefully managed event designed to maximize company valuation, optimize shareholder returns, and solidify the company's future growth prospects. Investor relation departments act as vital communicators between companies and investors, ensuring transparency, trust, and compliance with financial regulations. They handle comprehensive financial disclosures, quarterly reports, press releases, and investor briefings. Simultaneously, credit rating agencies like Moody's, Standard & Poor's, and Fitch provide essential financial stability indicators, assigning ratings ranging from AAA, symbolizing exceptional financial health, to lower grades, indicating potential risk. These ratings significantly influence investor decisions, lending costs, and corporate reputation, underlining their critical role in maintaining market integrity and investor confidence. Contemporary American markets are technologically advanced, highly regulated, and more accessible than ever. Innovations like algorithmic trading employ sophisticated computer algorithms executing high-speed transactions, significantly influencing market dynamics. Trading platforms like Robinhood have democratized investing, empowering millions of everyday investors with unprecedented market access. Concurrently, evolving regulatory frameworks continually refine market operations, safeguarding investors from fraudulent activities and market manipulations, thereby ensuring sustained market integrity and investor protection. Globally, major exchanges such as London's FTSE, also known as FTSE, Tokyo's Nikkei, the Shanghai Stock Exchange, and Euronext significantly influence international financial stability and economic development. Each exchange reflects a regional economic health, influencing global investment flows and economic strategies. For instance, the Tokyo Stock Exchange mirrors Japan's technological and manufacturing prowess, while London's FTSE provides a barometer for European economic stability. These interconnected markets illustrate the deep financial interdependence driving global economic integration, facilitating cross-border investments, and fueling international economic growth. Stock markets and economic conditions maintain a delicate symbiotic relationship. Economic indicators like GDP growth rates, employment figures, inflation, and interest rates directly impact investor sentiment and market performance. For example, economic expansion typically correlates with rising stock prices, while economic downturn may trigger market declines. Central banks wield substantial influence through monetary policies, adjusting interest rates and liquidity provisions, thereby profoundly affecting market dynamics. Understanding these interactions is critical for investors seeking to navigate market volatility and capitalize on economic trends effectively. Despite inherent volatility, the stock market remains indispensable, underpinning global economic prosperity. It plays a critical role in financing innovation, entrepreneurship, and economic expansion. Retirement funds, pension funds, and institutional investments depend heavily on market stability and growth. Ultimately, the stock market's resilience stems from its adaptability, continuously evolving alongside human ambition, technological advancements, and societal progress, thereby securing its perpetual significance in the global economic landscape. Ultimately, the stock market transcends mere numbers. It encapsulates the human spirit, reflecting ambition, resilience, hope, and progress. As long as humanity dreams and innovates, markets will remain the vital heart of global prosperity. The currency of the world is the US dollar. To know how it came to be from its very inception, click over here and I'll see you there.